Thank you, Anita. Good afternoon, ladies and gentlemen. We are in a very pertinent session in the Cafe Mutual India Investment Summit today. Over the past few months, I'm sure most of you have this question, and we have been asked this question by a lot of our investors, a lot of our channel partners, that where does the value lie? Over the last few years, post the COVID shock, we saw the rise of the mid caps and the small caps. And while Ajay did allude to some of the valuation parameters, what is on everybody's mind today is that where does the value lie? Where would investors look to make money over the next couple of years? So we saw that post-COVID, you had a staggering rise in the earnings of the mid-cap and the small-cap space. But what is the future looking like? What does it hold for the investors? Where do they make money from? So let me start with Madan, and if you could throw some light on where do you see value across which segments of the market, Madan?
Hi, good afternoon. We always try to be very realistic about the India growth story. When you look at the three cap curves, we approach each of these cap curves with a different mindset. So first thing is we are trying to be very realistic on our growth assumptions. There are certain challenges for India as well, like what Vora explained. There are good opportunities in India because India's urbanization story, India's infrastructure story, a huge working population, all these are pretty positive things. But we also have challenges. We have a very high interest rate compared to the competing countries when it comes to manufacturing. So we have certain very realistic assumptions on what is happening in different segments of the economy and try to be a lot more bottom up in terms of picking the sectors as well as the stocks within it. In that perspective, when I look at the large, mid and small cap as an opportunity, a lot of our alpha has always been created by investing into some structural stories in mid and small cap. Like one of our idea like Trent and Zomato. Trent has almost moved from 20,000 crore to 240,000 crore in a span of 6 years. Organized retail story in India, but not every retail company has done this kind of a growth. It's been one of those exceptions, and it has been run by the management who has executed the growth in a very meaningful manner. So a lot of our alpha has been created by picking those structural stories in mid caps and specific cyclical stories in small caps. So when we go into mid and small cap, we look for such stories and also some growth cyclicals. But we also look at large caps. And today you cannot go into large caps looking for a structural story. Because if you are looking for a structural story in large cap, it's going to be 10% sort of a growth. Every sector there, almost 70% of Nifty is in traditional sectors, and they are not growing more than 10%. So when we get into looking at opportunities in the large caps, we look for turnarounds, like what ITC did in 2021, what something like Bajaj Auto did last year, or what ICICI Bank did in 21-22, or Reliance did before COVID. So these are companies which are not going to structurally give you more than 15% return on a compounding basis. But there could be a period where they can give you a really good return in a 1 to 2 year time period, like what Bharati is doing. So we have a different approach to three cap curves. A large part of our money is always invested in mid and small cap, but it's invested in specific sectors and companies within those sectors. I don't want to paint a picture like, we generally don't try to paint a picture like everything is pretty gloomy and not the extreme, like everything is very optimistic in India. We try to be very realistic when we pick these stocks across the three cap curves.
Thank you, Madan. Recently, RBI had lowered the GDP projection by about 60 basis points, while increasing the inflation projection for the year by about 30 basis points. Ajay, how are you reading these numbers?
Yeah, so I think, what we have seen over last 6 months or so, a couple of factors I think has played against the growth rate, and one primarily being much slower government capex, because we had a election period and also a very heavy monsoon period. We have seen government capex declining significantly. And as we all know that for the past 3 to 4 years, they had taken the lead in terms of spending, which led to decent number of growth. So I think that is one factor. And as Madan also pointed out, that because of higher interest rates for a fairly long time, and to some extent inflation, The entire rural economy is also, was lagging, although it has now started to pick up a bit. But a large part of the rural economy was lagging. Because of those two factors, I think the growth rates have been a little lower versus expectation. But as we have seen the recent action from the RBI and also some positive statements from government in terms of how they are going to catch up on the spending, we don't take 1 quarter, 2 quarter view. But my sense is that over next 4 to 6 quarters, if government picks up on the spending and therefore, the whole liquidity cycle also improves in the system, we can get back to the earlier expectation of the growth rates.
Sure. Thanks, Ajay. The other thing that we have seen over the last almost this whole calendar year has been the sell-off by the FIIs. Right, we saw almost some $11–12 billion going out from the Indian markets in the month of October, and I think they have been just slightly positive for this whole cumulative calendar year. Now, one of the presumptions and one of the sentiments that the clients have is that when and if the FIIs come back, not if, I'm sure it's when the FIIs come back, one of the presumptions is that most of that money could come into the large caps. Would you think that theory holds water?
Yeah, so no, when we speak about FIs, we tend to think of them as a monolithic block. FIs come in different shapes and forms. At the one extreme, we're talking about prop desks of large investment banks. This is really hot money. It comes in and goes very quickly. When you saw the Chinese stimulus, you saw $10 billion go out in a month. That's not long-term allocator money. That hasn't moved out of India at all. The next stage is the global funds or emerging market funds who might move allocations away from India or into India. That as a percentage is anyway falling, particularly emerging market as an asset class like Ajay showed in his presentation has disappointed investors significantly. China was a significant part of that emerging market weight. China has clearly laid its cards out in the open that they don't want private capital to make money. As a result, the only emerging market left in the country is India. So therefore, a lot of the long-term allocation is moving into India-dedicated funds. So we as an asset manager, we manage money for some of the global institutions, the pension funds, endowments. We're seeing significant interest into India-dedicated funds. The only thing that's holding them back has been the valuations. We're trying to explain, like Ajay did, clearly India has a significantly larger share of high return on capital companies and therefore a premium is deserved. Having said that, I think we're also telling them that there could be a better entry point given that we are at a cyclical high, both in terms of valuations and earnings. As we've seen over the last couple of quarters, earnings is in a cyclical slowdown. I won't raise any alarm bells here. The structural story on India is pretty much intact. At the end of the day, any economy is a cycle. We do go through slowdowns. We're going through one such slowdown. Therefore, to answer the question around will FIs come back, I'm pretty sure I have a vantage point where we discuss potential investments. Long-term allocators are waiting on the sidelines. In fact, any sustained correction will be healthy to bring in that long-term capital into India. And I'm pretty confident we'll get that money back. So we shouldn't be worried too much about short-term corrections. So to answer the question on, for the panel around where does value lie, I think you need to look at it with two different lenses, the short-term and the long-term. Short-term, clearly valuations are totally out of whack with earnings. I think Q2 earnings have been pretty bad. We might see a bounce in Q3. In fact, small caps which have done phenomenally well over the last 3-4 years have taken the bigger beating in terms of earnings. Not many people might realize Q2, the 251st to 500 stock as defined as small cap by AMFI had a PAT decline. Forget about growth, it was a PAT decline. And the extent of decline, you wouldn't imagine, it's about 28% decline for that cohort, right? And at the same time, in the recent correction, we've seen small caps continue to outperform. While Nifty has fallen 8 to 10%, small caps have barely fallen 2 to 3%. So the valuation gap is only increased. The other way to look at it from a cyclically adjusted price to earnings perspective, which takes into account cyclicals ups and downs, Nifty valuation is slightly short of its peak that we saw in January 2008, right? This was the peak valuation. Whereas small and mid caps is still way higher than that 2008 peak. So this, sort of disruption between valuations, earnings growth has to correct somewhat. And the best way to address such cyclical dislocations is through the asset allocation framework. I don't need to tell you guys more. I'm sure all of you guys are doing that. So simply put, if you had a standard allocation for small caps, given the outperformance of small caps over the last 3-4 years, the right thing to do now would be to reduce allocation to small cap. Now, the reduction in small cap could come through redeeming some of the small caps or allocating incremental capital into large caps. Having said that, the longest term story is where I would agree with Madan. India is a bottom-up story. There are plenty of businesses which do well irrespective of the macro, and that's best left to the fund manager because we're seeing significant breakdowns in entry barriers across sectors. Larger companies which used to be protected through those entry barriers of, say, brand and distribution have been disrupted by a whole host of challenger companies coming from nowhere. Therefore, it is important to keep a more bottom-up approach and leave the fund manager to do the stock picking. In the longer run, I think India will see a whole host of new business models, many of them coming from the small and mid-cap space, which will deliver structural growth and structural returns. In the shorter term, I think valuations are out of whack, and asset allocation framework would help clients and yourself do better.
Thank you. Ajay, we saw your slide earlier in the day about India's 10 trillion journey, where you are playing it through the acronym pragati, right? Premiumization, transformation, and globalization, right? Now, within these three categories, where do you think the market caps could probably benefit from this move of, let's say, the premiumization or the globalization?
Yeah, so I think clearly the biggest theme I think that can play out for the country, according to me, is the whole consumption. And we have seen that happening with many other emerging economies, as I said. Because considering that the disposable income is on a rise for the segment who actually wants to spend, so there'll be a pocket where the income levels are lagging. But we have seen this with many businesses or economies that the top 20% is something what drives the whole segment. So similarly in India, if you look at it, the way demographics are changing and where the disposable income is moving, people are moving towards convenience and premium products versus need and maybe one level up. And that is where I think the more and more businesses will evolve and more categories will get built into this country. That is one place, the whole consumption basket, because as I said, right now we are 60% of the economy is on the consumption. So we have close to $2.5 trillion. I think over the next 5-7 years, the consumption economy itself will be close to $5 trillion. So that is one big area, and within that, as I said, categories will get built. And secondly, I am pretty confident about this whole export opportunity which India has. So, right now, things may be a little slower, but as I said, we are seeing in certain pockets, I would say that, if you look at the whole API space, where global majors are de-risking their supply chain, and couple of large API players have benefited because of that. Just to put certain numbers into perspective over here, a very small company, few quarters back, they were doing 30 crores of operating profit on a quarterly basis. Today, in a matter of 5-6 quarters, they are doing 150 crores. So 5x in a period of 6 quarters. That is the kind of traction. Obviously, that included fresh product, new products and everything. But that is the kind of, I would say, traction that smaller companies are seeing on the export side. And be it, API, or even our conversations with many textile players actually tells us that because of what has happened on Bangladesh or, many other reasons, most of these factories are running at full capacity after a fairly long time. So my sense is that, export also as a theme, there'll be certain smaller sectors where the market caps can grow up by almost 3 to 5x in a shorter period of time.
Right, and as a follow-on question to that, within your the Pragati theme, which market caps do you think could accord more growth?
Yeah, so this Pragati theme, we have a strategy in place which is only focused on small and mid caps, and obviously markets have done really well over last 2-3 years, and so has our portfolio as well. But I think that way building blocks have been in place for the economy. I think our focus for this particular strategy has been on mid and small cap companies versus the large cap, where we believe that for investors who have a longer horizon as well as a little bit of higher risk appetite, the risk reward ratio can be pretty non-linear over there. If we are able to identify stories which are aligned to this theme, the compounding can be in excess of around 30-40%. So small and mid cap is the space where we are continue to remain positive with a longer horizon.
Sure, thank you. Madan, I remember seeing one of your earlier interviews where you had mentioned that India is structurally moving away from a services-led economy more towards the manufacturing side. Now, essentially, if you see most of these players on the manufacturing side, barring the large ones, are all the SMEs, MSMEs, which essentially are in the mid and small cap space. So is that a theme, is that a story that you would be allocating more capital towards?
Yeah, definitely. If we look at the kind of opportunities pre-COVID and post-COVID, manufacturing as a space has started to throw a lot of opportunity. Obviously, a lot of them is captured in the valuations today. Like EMS, we were probably the early set of investors who got into Dixon. When the stock was probably trading at some 20 times multiple, doing an EMS assembly work, looked very fair. Company was doing a 2,500 crore revenue. We thought it can go up to some 16,000 crore in 5 years. It went up to 30,000 crore right now. So it was well identified, and now I see all the companies with the name of EMS is trading at 70, 80 times. So now where will we make money 5 years down the line in these stocks? And are we hoping these companies will trade at 70 times continuously? Probably so. But if there is any small disappointment on earnings growth, you are going to see a sharp correction in their valuation from 70 to probably 30 times. Now, whether it will happen in a year or so, but it will happen in a 5-year time period. So that depends on how you look at this. But obviously, a lot of this manufacturing story, we approach in a different way. Some of the small cap companies, particularly from a global export point of view, I'm not a person who buys into this India becoming a manufacturing center of the world very soon, because China offered a significant saving in employee cost. That's why Japan or Korea or even US or Europe, a lot of companies shifted to China. I don't think India is offering that at this moment compared to China. India is right now, we are saying we are good in assembling, probably we will graduate. So better we look at the domestic consumption oriented manufacturing. So there we see some opportunities like what happened with the solar cell manufacturing. There is a restriction that has been put by the government that you have to procure it from the domestic manufacturer. Those kind of opportunities are appealing to us. I see that happening in renewables because there is a growth happening there. I see that happening in battery manufacturing, which is electric vehicle battery manufacturing. There will be a import duty or there will be a restriction to import in India. So you can get some good opportunities because some of the lead acid battery companies are transitioning towards electric vehicle battery manufacturing. So those are certain opportunities. When we look at export, we are very specific and there are some opportunities come, but it has nothing to do with India's story as a manufacturing center of the world. It is about that particular company or an entrepreneur who has done well in a very specific product and he is benefiting out of that and exporting out of India. So that's how we see that opportunity.
Pramod, given the recent changes across your portfolios, how have you been able to align them across these market caps?
So we've had separate portfolios because we think that allocation is our advisor's job. They do the asset allocation, we are asset managers. At the end of the day, we are focused on delivering alpha. We don't do size allocation and we let the investor or the wealth manager choose the particular product because allocation depends on individual preferences, individual situations, risk appetite, so on and so forth. So if we try doing that, then we'll be doing our allocator's job. Having said that, I think there was a time when small caps were very attractive compared to valuation and growth prospects. Today we are seeing the other way around. We think value more in large caps or the larger mid caps. And to that extent, we're tilting the portfolios more towards large. But like I said, from a longer term perspective, we do see the growth potential significantly greater for small caps. We're just hoping some sort of correction. The reason the correction hasn't happened, I think, is the answer lies in this room in terms of the flows, right? Clearly, the performance of small caps over the last 3-4 years has meant that a large part of the inflows into mutual funds is coming into smaller cap funds. Despite the fact that a lot of small cap fund managers are increasing their allocation to cash and to whatever extent the law allows them to allocate to large caps. You know, some of the larger holdings in small cap funds are actually large caps. So they're also suggesting the same thing, that we don't see any value in small caps, but this is a self-fulfilling effect. If flows come into small cap funds and the manager is forced to allocate to small caps, and small caps by definition are very illiquid stocks, that buying itself will ensure valuations are kept high, despite the earnings numbers that I shared. At some stage, I think the answer as to when small caps will become attractive lies in this room itself, because it'll have to be driven by fund flows either stagnating or reverting back to larger cap funds. At that stage, this gap between valuations and earnings should give rise to a proper correction. Hopefully, you know, we have a long list of small cap names on our shopping list. We're waiting for the right prices to appear on the screen, and that should give us a better opportunity to buy into it. From an allocator's perspective, I think this whole flexi cap fund concept makes a lot of sense, because that allows the fund manager to be market cap agnostic and buy into the right combination of growth and value, rather than you know, us trying to second guess what will do well over the next 6 months or 3 years.
Sure. Now, there is this the two distinct investment styles, right? Growth and value. Now, we have seen growth coming in on the mid caps, on the small caps, and with the recent correction, do you think the value has also come to that segment, Ajay?
You are saying that
Is the valuations kind of justifying some kind of cherry picking on some of these small cap, mid cap names?
No, so actually if you look at the near-term earnings profile, it will not. But one needs to have some sort of understanding in terms of how the business will shape up over the next 2 to 3 years. So I'll just give you a classic example. You know, one of the, say, consumer durable companies, they had a bad quarter, right? And stock corrected by almost 30-40% over a period of 1 month. Now, if you look at the current quarter and the next quarter for them, and if you talk to the management, they are talking of significant demand recovery and also margin recovery for them. That is, you know, for the near term. But the way I look at it, if a company is doing a revenue of, say, around 5,000 crores and market cap is close to 6,000 crores, the clear worry which the market has is in terms of the margin profile of the company. Now, if you believe that company will work towards improving the margin profile and it will move up by 300-400 basis points, which is in line with the markets, right, the peer set, then there is a significant headroom for the stock to do well even from here on. So it's a small cap company, but my sense is that, you know, whether that fits in value right now, but eventually India is a growth market. So you have to figure out, you know, eventually that stock has to deliver 30, 40, 50% growth for investor community to get excited. So right now, I think that post-correction, there are certain pockets where value has emerged. But obviously, as the other panelists are saying, that it is definitely at a significant premium versus the large cap. But I strongly believe that India has always been a bottoms-up market. In any kind of a market scenario, you will end up finding some or the other value in mid and small cap, and that is where you'll end up making big money.
Sure. So we have been hearing about the huge valuations on the mid cap and the small cap space, right? Now, and we are comparing it to historical means, saying that compared to the historical averages, the current valuations on the small cap and the mid caps are higher. Now, as I hear from all of you and what we have also been doing across our portfolios, we have seen a lot of emerging sectors, a lot of emerging themes He spoke about aviations, apparels, you spoke about some of those. Do you think there is merit in comparing the current valuations to the historical averages when a lot of these sectors which we spoke about were actually not there 2-3 years back?
Yeah, that's a difficult thing to actually judge. But what I would say is, particularly when you look at mid-cap is an interesting animal. Mid-cap is like a railway junction. There are certain trains moving from south to north, becoming from small cap to mid-cap to large cap, which are there sitting in mid-cap. There are also trains which are moving from north to south. From large cap, they move to mid-cap, and potentially they might move to small cap also because of long period of underperformance. So which side of this mid-cap we are interested is the key thing. Last 2 years, it didn't matter. You can be in any of these and you would have made money. But next 2-3 years, you have to choose on which side of this to be. If growth is going to suffer, and as I started this entire discussion, that we believe that India growth story is there, but it is not as if it's the way it was judged in the last 2 years, that the earnings growth expectation went through the roof, right? Mid-cap earnings growth expectation last year, I saw it was 25%. Today we have cut it down as low as 15%. Probably will end up doing 12% because the breadth of companies delivering more than 15% growth is narrowing very fast. So in that scenario, I think from a long-term perspective, you are mostly on the sectors which I said, emerging sectors, which are capable of moving from a mid-cap to a large cap or a small to mid-cap. I think if you're there and be conscious about valuation, if not overpaying, it still makes sense. You're not going to get them cheap, but when the breadth of earnings growth reduces in the market, the concentration of performance also reduces. And that period, we have seen market rewarding growth, quality growth, even if it is slightly costlier. So that is the phase I feel in the next 2-3 years Indian market might go through. It may not be as narrow it was in a pre-COVID period, because pre-COVID period was all about large caps, right? Because mid and small caps were going through earnings cut completely, and then large caps were doing, and even companies growing at 15% was getting something like 50-60 times multiple, and it was expensive. So same thing that is happening in mid-cap today was happening in large cap at that point of time. So it's important that you differentiate, because some of these mid-caps are capable of growing more than 25%, and they might be trading at 40-50 times. I think you need to give that premium to play them. And once the breadth of performance narrows, this outperformance can continue.
Sure. Now, pardon me for being a salesman, pardon me for pitching a small bit of salesmanship there. So we have this, one of the portfolios at Motilal Oswal called the mid to mega, and we just spoke about that, right? Some of these, identify some of those trends, some of those stocks, which can become the large caps of tomorrow. And of course, you are at Marcellus running consistent compounders. So coming to consistent compounders, where is the consistent compounders going to come from? Which space?
Yeah, I think Madan made a very pertinent point in terms of the changing market structure. The period between the 2G scam and COVID, roughly that decade in India, was a very rare period in Indian economic history. It's a very unique period. India as an economy did not see a capex cycle at all in that whole 10-year period. As a result, large part of the economy was largely lifted by consumption. Now, if you have 140 crore mouths to feed, they will spend on something, and that held up the economy. That unidimensional nature of the economy also translated into a unidimensional nature of the market. There were only a handful of stocks that worked in the market, primarily consumption-oriented. IT and pharma did well because they had nothing to do with India. They are global-facing sectors. A couple of banks like HDFC and Kotak did really well, not because credit growth in the country was high, it's because the rest of the banks were dead. And as a result, there were about 15 or 20 stocks which did all the heavy lifting for the market in that decade. But that decade also saw a lot of repair work done by the government on the economy. For example, the banking system was recapitalized. Therefore, the banking system today perhaps is at its pinkest of health that India has ever seen. At the system level, 17% capital adequacy ratio. I don't remember that number seeing it ever in history. So we're in a better position for the financial system to support capex growth or investment cycle growth. That has meant that the economy has become a lot more broad-based today. As you've seen over the last 4 years, it's not just consumption, capital-intensive industries across real estate, infrastructure, capital goods, industrials have all done well. And therefore, we're becoming a lot more broad-based market as well. The opportunities or the pond in which you can fish is become a lot more wider. And you're also seeing all sorts of new business models coming into the market, IPOing them. So as a public markets manager, in terms of your ability to add value has never been better, right? For a stock picker, this is the best environment to be in, as opposed to the last decade where consistent compounding, you bought the same old HDFC banks and Asian Paints of the world and you could compound. But now we are seeing a completely different environment. Like I alluded to, technology changes have meant that brand and distribution and supply chain as sources of competitive advantages, which meant the large were getting larger and larger, has been broken down massively. Today, you can launch a D2C brand in India without any distribution network. You can use 3PL logistics providers and make sure your product is available in the remotest corners of the country. You don't need the advertising budget of a Unilever to compete with a Unilever. Using digital marketing, you can do targeted advertising to consumers directly at a fraction of the advertising budget and build a brand of your own. And that is giving space to a whole host of new challenger sort of companies. It's not the same old anymore. And that means that for consistent compounding, you also need to look at enterprising compounders, new age entrepreneurs, new age businessmen, new age business models which are coming in. And hence, within our consistent compounders portfolio also, you've seen a significant shift in terms of allocations. From being a very concentrated portfolio, we are diversified. Not just diversified in terms of number of stocks, we are diversified in terms of exposure to sectors. It's not just consumer, IT, and healthcare anymore. And as a result, I think as managers, we need to be alive and awake to these changes. And rather than sitting on what's worked yesterday, always keep your eyes and ears open for what are the changes that the economy is going through. How should I reflect that in my portfolio? And be open to change. I mean, this is a profession which, perhaps in my view, the number one personality trait is humility. So you'll need to accept where you were wrong and make changes accordingly. And eventually the market will reward you.
Perfect, thank you. With an eye on the clock there, maybe as we conclude, if I have, let's say, $100 with a big risk appetite, long-term investment horizon, how would you gentlemen allocate my capital across large cap, mid cap, small caps?
So I think that, that clearly will depend on an investor's risk appetite and time horizon. Obviously, that is the primary, I would say, the base criteria. But I would say that to benefit from what actually is happening in India right now, and have I would say, a much better compounding, I would suggest, and this is ballpark numbers, I would suggest anywhere between 40% odd into large caps and 60% into mid and small cap. I know it may sound a bit on the aggressive side, but I think that, we are seeing some sort of major structural shifts taking place. And this definitely will be for, next 3, 5, 10, 15 years. So my sense is with a 60% mid and small cap and 40% large cap, one can expect a very high compounding.
Madan?
Although I spoke so much about valuations on mid and small cap, currently the portfolio is 30-30-30 with 10% cash. But it is purely to do with those specific stocks and those specific sectors and what is happening there. We still feel a lot of opportunities keep coming in the mid and small cap, particularly small cap space, some very niche companies keep coming. So from a risk management perspective, we believe in having bucketing approach, both from a value growth perspective as well as from capital perspective. So balanced approach is, I think, gives both the alpha generating opportunity as well as being little bit on paying attention to the risk as well.
Thanks. Pramod, your thoughts, please.
Well, I won't put a number because I think asset allocation is a very personal thing depending on the client's specific situation in terms of risk appetite. But I'd like to make one point why, even if you're the most aggressive investor with the longest time horizon, I have had clients like that saying that, Pramod, I don't need this money for the next 10 years, so therefore I want to put 100% of my money in small caps. I still advise against that. The reason being, popularly it's understood that diversification or asset allocation across asset classes is a risk reduction tool. Of course, it does reduce risks. There's absolutely no doubt volatility is much better. But I would like to argue that it is also a return enhancement tool. If you have uncorrelated assets in your portfolio, and as we've seen over the last decade, there have been periods where large caps have done well, there have been periods when small caps have done well. So their correlation tends to be significantly less than 1. When you have such uncorrelated assets in your portfolio, whenever there is a dislocation in one asset over the other, it presents significant opportunity for rebalancing and improve your overall returns. Right? And we've shown that when there is a drawdown, there will be an inevitable drawdown in small cap. When that drawdown happens, you will need to be in a position to capitalize on that opportunity. You'll need to buy into that drawdown. For you to buy into that drawdown, you need dry powder elsewhere in your portfolio. Where will you get the dry powder from? If you have another asset class, say large caps, which hasn't corrected, that will be the time to draw capital from large cap and buy into that small cap. And hence, even if you're the most aggressive investor with the longest time horizon, I wouldn't advocate 100% allocation to any single asset class.
Sure. Thank you, gentlemen. It was a very insightful session. I hope you also found it to be insightful. I hope you have a wonderful rest of the day. We have some very good speakers coming up next. Thank you so much. Thank you. Thank you.